Domain actions. Eminent domain is the right of the government to take private property for public use. The right of eminent domain can be exercised by the federal government, state governments, local governments, and numerous governmental agencies, such as school districts, sanitation districts, public utilities, and others. The process by which eminent domain actions are taken is called condemnation. For example, suppose that the state decides to build a new freeway through a particular area. The state would have the right to take the land through which the freeway will pass from the owners of that land. The state would condemn that land. The Fifth Amendment to the United States Constitution requires that private property cannot be taken without just compensation. This means that when a property is condemned, the agency using its eminent domain power must pay the owner of the property its fair market value. The determination of this fair market value would require an appraisal of some sort. The agency exercising its power of eminent domain would obtain an appraisal of the property. If the owner did not agree with the value, the owner has the right to obtain a separate appraisal and challenge the value in court. The appraiser who conducts the appraisal of the condemned property is under a special burden to justify the final estimate of value. The interests of the two parties are certainly not the same. The governmental agency who is condemning the property is of course looking to pay as little as possible for the property. The property owner is of course looking to receive as much as possible for the property. The appraiser should expect that the appraisal will ultimately be challenged in court by either or both parties. Since litigation is likely in a condemnation action, appraisers will go to great lengths to support their conclusions. Appraisers in condemnation actions will generally look for a greater number of comparable properties than they otherwise might. Most appraisal reports in condemnation actions will be in the narrative form, which is by far the most comprehensive type of report used. This allows the appraiser to better document the conclusions in the report. Narrative reports will be discussed in greater detail later in this book. Property tax assessments. Prior to 1978, the county assessor's office in each county in California would determine the assessed value of each property in the county. Property taxes would then be levied on a percentage, usually 25%, of this assessed value. In the 1970s, a dramatic surge in inflation resulted in huge increases in the market values of real property. These price increases resulted in equally dramatic increases in assessed values, and therefore in property tax liabilities. These increased property tax liabilities posed problems for homeowners, especially those on fixed incomes. This increase in property taxes resulted in the passage of Proposition 13 in June of 1978. Proposition 13 made drastic changes to how the property tax was levied in California. It required that after June of 1978, the assessed value of a property would, usually, be the last price at which the property sold. If a property had not been sold since March 1, 1975, its assessed value would be rolled back to that date. Assessed values may be increased each year, but by no more than 2%, as an offset to inflation. Since Proposition 13 took effect, properties are now reassessed only when they are sold or otherwise transferred. This change in assessment policy vastly reduced the valuation functions of the county assessor's office. The assessed value of a property is ordinarily determined by the last price at which the property was sold, rather than the assessor's estimation of value. There are still occasions, however, where the assessor's office will determine the value of all, or a portion of, a property. These situations include: if a property is sold or transferred for less than its reasonable market value, the assessor can appraise the property for its fair market value. An example of where this might occur would be if a house is sold for $1 from one adult sibling to another. If a property is improved, such as by adding a new room, the assessed value will be increased by the value of the addition. The value of the addition is most often determined by using its cost. If the property owner disagrees with the assessor's estimate of value, the homeowner has the right to appeal the assessment. Appeals are filed with the Assessment Appeals Board of the county where the property is located. The owner may choose to get a professional appraisal of the property to support the owner's contentions. Divorce actions. Appraisals are sometimes required because of divorce actions. To use a common example, suppose that John and Mary Jones own a house as community property, and they decide to get a divorce. As part of the divorce settlement, suppose that Mary will receive the house but must give John an amount of cash equal to his share of the equity in the property. The best way to accurately determine the equity in a property will be to obtain a professional appraisal of the property. The equity will be the appraised value less the loans against the property. In some ways, an appraisal for divorce proceedings can be similar to an appraisal for eminent domain. The two former spouses will be at cross purposes with regard to their estimate of value. The spouse which must pay the cash will look for a value as low as possible. The spouse who will receive the cash will look for a value as high as possible. The appraiser must be careful to maintain neutrality and objectivity. Divorce actions sometimes warrant narrative appraisal reports, although the higher cost of issuing a narrative report must be considered by the litigants. Estate taxes. If a person dies and leaves an estate with a value in excess of $600,000, there may be an estate tax liability to consider. This may necessitate the appraisal of properties owned by the person who died. One of the unusual features of appraisals done for estate tax purposes is that the value of the property must be determined not as of the current date, but as of the date that the person died. The date of death might be several years before the appraisal is requested. Gift taxes. A person who gives a gift in excess of $10,000 or $20,000 for married couples may be subject to a gift tax liability. It should be noted that the tax is paid by the donor, not the done. Suppose that a parent gives a house to a son as a wedding present. The parent would be liable for gift taxes based on the value of the property, less the $10,000 or $20,000 exclusion. The gift tax is based on the market value of the property at the time of the gift. If the parent purchases the property and immediately gives it to the son, the gift tax would be of course based on the purchase price. If the parent had owned the property for some number of years, it would be necessary to have the property appraised to determine its current market value. Real estate brokerage. The functions of a professional appraiser and the functions of a real estate broker or salesperson are very much related. One of the major tasks that they each perform is determining the value of properties. Brokers and salespeople perform this task for buyers and sellers in an informal manner. Appraisers do so in a more formal manner, and often for other market participants, such as lenders. Enjoy YakitoMe without advertisements for less than 98 cents a month.